But if you're in the growth phase and whatnot, those dividends are going to buy more shares of stocks on these dips, when those dividends reinvest. So, that certainly makes sense, and, we don't want to discount rebalancing portfolios, right? So if your overall risk tolerance is 60% stocks, 40% bonds, look, you could certainly make the argument that, look, should I rebalance right now? And we can talk of the merits of that. And, that's different than selling and going into cash and waiting for the election to come over. That's the biggest.
How do we deal with market volatility and managing our investments for our financial and retirement confidence and security? We'll talk about it today with Chris McIntire on your game plan for retirement. Chris McIntire and McIntire Retirement Services, of course, your local resource for a common sense approach to planning for your financial, investment, and retirement future. We always appreciate the guidance and the common sense that Chris provides, bringing us some levity and more cooler heads to prevail in times where sometimes, Chris, that market volatility can lead us to making emotional mistakes with our money. So we'll talk about how to deal with that today. And we do appreciate the time, Chris. I do want to remind you, ladies and gentlemen, that if you've got questions or concerns about your investments, your portfolio, you are always welcome to be in touch. Just give a call, 800-868-1194, 800-868-1194. So, Chris, market volatility should not come as a surprise, and yet it always seems to.
Yeah, it can come very fast. That's what happened, earlier there in the month of August. We had that huge sell-off there. You had, kind of a Thursday, Friday, pretty negative days. And then that Monday, had a 1,000-point drop in the Dow and whatnot, and everybody predicting recession. And oh my God, they got to cut interest rates. And, you get a rally right after that. And, it turns out once you cut through the noise of all of that, the Japanese stock market had like its worst day in history, let's call it that. And that fueled some other things that had to unwind in the financial markets, what they call carry trades, and that's above your and I's pay grade essentially here, Peter, for the show purposes today. And so that led to volatility in the equity markets here. And, most people thought, well, we're diving into a recession. It's like, well, wait a minute. That the jobs report was positive. They hired 140,000 people. Yeah, the market might have been expecting 170,000 people, but my goodness, 500,000 more people entered the workplace. So it was just a statistic anomaly. And, we're all anticipating some interest rate cuts here coming up in the month of September, at least. You never know. Sometimes they act. I wouldn't expect them to act in an emergency cut because there isn't anything. There is no emergency right now.
Yeah. And Chris, what we have seen is that the market is cyclical. When we have a long spell where it has gone up and everybody's sort of appreciating the growth of the market, there comes a time where it's got to cool back off, especially if there's been a prolonged bull market. And some of the best days happen right after some of the worst days, some of the best months right after some of the worst months, some of the best years right after some of the worst years. So you really have to have a plan to stick with it and a long-term vision. I recently read a quote by Warren Buffett, who, of course, one of the most famed investors of all time. And he said that the market is a tool whereby the patient benefit by the impatient. So in other words, sticking with it long-term is going to be the thing that pays off ultimately.
Yeah, and Warren Buffett certainly knows. And, we've talked on the show here. Look, I love dividend paying stocks. So, when the market dips, your dividends, if you're in the reinvestment side of things, so, you're not drawing them for retirement income. But if you're in the growth phase and whatnot, those dividends are going to buy more shares of stocks on these dips, when those dividends reinvest. So, that certainly makes sense, and, we don't want to discount rebalancing portfolios, right? So if your overall risk tolerance is 60% stocks, 40% bonds, look, you could certainly make the argument that, look, should I rebalance right now? And we can talk of the merits of that. And, that's different than selling and going into cash and waiting for the election to come over. That's the biggest thing that I'm hearing from clients right now. Everybody is election fearing, and now we know who the candidates are going to be at least, and
We think.
yeah, but
Right.
this country has elections every 2 years with the House of Representatives, a third of the Senate, and then every 4 years the presidential cycle. And we all want it to be a peaceful transition of power or not, depending on how you're going to vote. But we're obviously going to get a new president regardless.
Yeah. Well, Chris, you hit on a couple things that we definitely want to touch on: how elections impact market volatility, or should we react at all to them? I think I got a little hint of that from your answer right there. But you mentioned the Asian and specifically Japanese markets. We are more in a global market today than ever before, so things overseas do tend to impact directly what goes on in our market. And at the latest Fed meeting, you talked about raising interest rates. Jerome Powell did mention that it felt like that the market was finally treating good news as good news and bad news as bad news, which has sort of been a trend that he has harped on for the last several years, has been opposite and flip-flopped, where he says, hey, y'all, the market's got to start acting rationally, because every time there's good news, the market acts like it's bad news because it's waiting on the Fed to step in and support it. So I guess my question in all of that, Chris, how much does the direction of the Fed or what they decide to do actually impact the market and potential volatility?
Yeah, it's huge right now with the interest rate piece, that we're dealing with. And, and to give some bullish talk to the market, which means the market could go up. There's a lot of money sitting on the sidelines, and I believe there's about $6 trillion in money market dollars sitting on the sidelines. So if interest rates get cut, it gets cheaper to buy houses, gets cheaper on credit card payments, used car payments, new car payments. So if it can open up the housing market, that would certainly be a good sign for the markets over the long haul, because when people buy a new house, they do some of the remodeling, they buy durable goods, washers, dryers, so on and so forth. And then some of that money in a money market account could go looking somewhere else for a higher interest rate, because if they cut interest rates, CDs are going to go down, money market rates are going to go down. And if they cut them enough, all of a sudden people are going to take that money market money, some of it anyway, not all of it, and move it into bonds that paying a higher interest rate, stocks that are paying dividends, that type of thing. So that's if you think about it, $6 trillion on the sidelines is a heck of a lot of money that could certainly add some add to the fuel and equity and bond prices in particular. And it'd be nice to get a good bond market rally also after all the interest rate increases. So a lot of signs out there that we could make arguments that we are bullish for the market. And I think, Peter, it's probably fair to talk about the signs that aren't so good for the market right now. Things are softening up a little bit. There's been an impact on inflation and higher interest rates. We got geopolitical things going on right now in the Middle East, that certainly seems like more of a powder keg than at any time in recent history.
Yeah. Yep. Well, investors, Chris, should be no stranger to the fact that market volatility is ever present, especially with all of those factors. And yet, every time it happens, it feels like it is a surprise and the rug has been swept out from under our feet. And the bottom line is that there are many, many causes for market volatility. The market cannot go up forever. So when it changes directions without a plan, it can cause fear, anxiety, and then investment mistakes. And that's why, ladies and gentlemen, we are here each and every week with Chris McIntire on your game plan for retirement, trying to help you keep a level head and giving you the resource. That's the true value of the program, is that you've got a local resource that you can talk through your plan, your investments, and how you are potentially exposed to or protected from market volatility. Understand the risks that you are taking, the fees that you're paying, the taxes that you may be liable for. All of that comes as part of a conversation with Chris McIntire. If you would like to take up the opportunity for that complimentary review and planning strategy session, pick up the phone and give a call, 800-868-1194, 800-868-1194, 800-868-1194. So Chris, backing up to a little bit of a higher level here, we are taught to take risk, and I think there is some necessity to that for our financial progress. So can you talk about that necessity or the appropriateness of risk? And then how much should we be taking? Is there some gauge or formula for that?
Well, yeah, absolutely. We have, a program called Riskalyze that we utilize. We have our questionnaires that help determine risk, and, where's let's call it the pain threshold that clients have. And they say, look, I'm in it for the long haul. I know the market could drop 25, 30%. I'm young enough. I'm still putting money into it. I'm okay with that. Okay. We get into a lot of our folks that are, retired or just about retired. And, the bulk of them come into the moderate side to moderately conservative, all the way to, completely safe. We don't deal a whole lot in the 100% stock market, folks. That's just not the nature of our business, because we typically help those that have made it to retirement or close to, and then how do we structure to get them through retirement? And some of that is mitigating stock market risk, right? Mitigating the risk of outliving your money, mitigating the risk of going into a nursing home, mitigating the risk of inflation. So many different risks that are out there, Peter. So to circle back to your original question, probably more around the investment risk here is, we take the rule of 100. That's kind of a rule of thumb, a starting point when we're talking with someone. And if they, if their risk tolerance says, well, all right, well, you know what, I'm going to take my age, which is 65, and take that from 100. So I should be 65% in some sort of safe investment, bonds, CDs, money markets, annuity side, and then the 35% basically in your stock piece for long-term growth, right? You need to keep the pace of inflation. So you have to be careful erring on the side of too cautious, just like you have to be careful of erring on the side of too aggressive in retirement when you're pulling money out of your portfolio and you want to mitigate those large drawdowns. And for those of you that watch the podcast, I think I'm half Italian. I talk with my hands a lot.
But there's a time and place for risk, in other words, and there's a balance with money we should and then should not be taking that risk with. And it's really about the asset location and intended utilization, right, Chris? Because money can do any number of things. It can grow, it can be safe, it can be liquid, it can provide income, but it generally can't do all of those things at once. And that's why we've got to have different places for it that are doing and accomplishing different qualities and goals for us. So there's an upside to risk and a downside to risk.
Yeah, without question, and you get like here in the end of in August, September, October, where we historically have a little more volatile times, and then leading up into an election, I suppose we could say there's a lot of uncertainty. You don't know who's gonna, control the taxing authority and whatnot, So, but anyway, that's why you have to build your portfolio around your overall risk tolerance. So when you get a bad month or two, you're not freaking out. You're like, all right, well, like right now, we have a normal interest rate environment here, and interest rates are probably going to get more favorable to consumers, which means they're going to lower them. That's better for bonds. Bonds are now performing their more defensive nature in when the stocks sell off. And, if you paid any attention to that day when the 1,000 points dropped, the bond market was basically flat. So if you were in a 60% bond portfolio, 40% stock portfolio, 60% of your money didn't really lose anything,
Yep. And that's the balance, Chris. It's going to help us maybe weather the storm when there is market volatility, if we've got that balance, and more importantly, perhaps have a plan ahead of time where market volatility, if we are properly balanced and properly prepared with a plan, can actually present some good opportunities. Some people look at it as troubling, to put it lightly, whereas other people look at it as an opportunity moment. And I think the difference is having the plan and being confident versus not.
Correct. Yeah. Buy the dip, for example. If you had money on the sidelines after one of those terrible days in the market, hey, that might not be a bad idea to buy something there at the end of the day, right? You're locking in for the next day's potential rally, we should say. And, but like Peter says, if you do your research, you'll notice that the market typically has its best days right after it has one of its worst days. And if you miss those best days, you are really hurting your portfolio's long-term performance. And, as much as people want to avoid, and I'm going to use the word losing money in the market, because you don't lose until you sell, right? I mean, if I own 80 shares of Apple stock and the price of Apple stock falls 30%, I still own 80 shares of Apple stock. I haven't lost anything until I hit the sell button and somebody buys it off me. Now I'm down, I mean, so the value, it's the difference between losing money, using the term, well, we lost money today. It said, no, the value just went down today. You didn't lose anything if you didn't sell, right? You still own everything there. Yep.
Yeah, well, same as looking at the house that I live in, Chris. Like the value was way up, but I didn't benefit from that because I wasn't planning on selling, right? On the other side of that same kind of comparison is that you've got to realize it for it to become reality, I guess. We talked about the appropriateness, the time and place, and the reality, Chris, that there will be market volatility. Question: how prepared do you feel the average American, the average investor is for the potential for market volatility? And how prepared should we be?
Yeah, and I would say that if we're addressing somebody who's 60 years old and still going to work for 5 years and they're in their 401k at work, they're probably a lot more aggressive than what they think, because they're in one of those retirement lifestyle funds and they probably have no idea what the stock position is versus the bond position. And most people are busy. This isn't a knock, I mean, they're working, two families, grandkids, kids, and whatnot. And they think that a 2025 fund just simply means, hey, I'm going to be set for retirement by investing in a 2025 fund. I'm going to lose very little money in that. And hey, that thing might be 60% stocks, 40% bonds. I mean, you need to look into them. And then as you work your way into retirement, is like, well, what is your safe strategy if the risk strategy, the investment portfolio, really takes a significant hit? Do you have another plan B in place? And I would think most folks who are working right now do not have that plan in place. They might have not a knock. Obviously, some people do. They've got a significant amount of savings or something like that. But in general, on the investment portfolio, I would say a lot of people are a lot more aggressively invested than they really want to be when they see the market go down, right? We're all greedy. When it's going up, why do we want to change and make a shift? We'll do that when it goes down, because that way we can lock in the losses. And I'm being sarcastic.
Yep. Well, Chris, again, we appreciate the perspective on market volatility and now a few rules for a sound approach to market volatility. And I think that top of the list, as we have been discussing, but Chris, is have a plan ahead of time. We don't want to be reactionary, but you've got a list of different items that we should consider to help us have a plan and the sound approach to volatility.
Yeah, we sure do, Peter. And, some of the things that we like folks to have is, look, what are the things you have to be living on? What does it take, to get through that monthly budget? Let's form the plan around that, and then what are our options on the safe money strategies? And, we do this a lot in clients, right? With a yellow notebook pad, say, look, here's the growth options. Here's the safe options. Here's the good and the bad and the ugly of every one of these options. Because as we all know, look, there is no perfect investment out there. We talked before, Peter, an FDIC insured CD isn't perfect. NVIDIA stock isn't perfect either. Finding the balance there that you can live with during the ups and downs is what's the key component to a solid retirement plan.
Yep, and be informed. Chris, you mentioned rebalance. Maybe even if we do have that plan in place and understand the opportunity that market volatility and a correction or a drawdown can present, contribute to your accounts, right? It's the opposite of how we're hardwired and our psychology, but there are several on our list here, your list, Chris, that are a little bit backwards to, I think, the emotional reaction that generally people tend to have. But rebalance, contribute to your accounts, perhaps even move to more aggressive strategies, right? Those are things that are opportune moments.
Yeah, and some of that stuff is hard to do because as human beings, we're conditioned to be very defensive and reactive versus being proactive. So, the market falls by 10%, 15%. If you have money, that's probably a good time to make an entry into it or add additional dollars, like Peter says. If you're working, you certainly still want to make those contributions because those are your future high rates of return. And a good example is if you put money in the entire year of 2023 into your 401ks and your IRAs, or I'm sorry, in 2022 when the market was going down, and then it rebounded 2023 and 2024. Well, look what you got out of that.
Well, Chris, you also are a self-proclaimed tax geek, and one of the items on your list was consider a Roth conversion. And I know that these are things that you plan out with your clients proactively during the course of the year, but why are times of market volatility perhaps opportune moments to execute on those intentions?
Yeah, and so we were talking about Nvidia stock before. So let's say your Nvidia stock fell 15%, right? You could convert that over into a Roth IRA if it was in your traditional IRA, slide it over into your Roth and let it rebound. You're paying tax on 15% less value. You still own the stock and now it can recover and it would be tax free. So it's a great idea, Peter.
And then, Chris, a couple proactive steps ahead of time. You mentioned have a preservation strategy. And you mentioned that there are a couple different kinds of protection. So while we are taking risk and there's an appropriateness for taking that risk with growth money on one hand, you've also talked about the fact that we want protection and mentioned that there is both protection for principal and protection for income. And both of those are probably essential to making sound decisions and dealing with the volatility on the other hand.
Yeah, certainly. A couple of examples: protecting principal, money market, CD, fixed annuity, fixed index annuity. All those have some form of protection of your principal. Okay. Protecting for income. Okay. If you don't have that standard pension that many people like your parents and grandparents may have had, and Peter and I don't have pensions, so we have to save for ourselves. Is you can use an annuity that can give you a lifetime income, maybe have the potential to increase that income over time, but also protect your principal base as well and give you some form of potential fair rate of return, right? We don't use variable annuities here in our office. We're not the biggest fan of them. We typically, if we're going to use an annuity, it's going to be on the safe side of the portfolio. We want to mitigate costs and also mitigate volatility. That's how we utilize them here.
Now, Chris, the last several years, though, have been a little tougher time for investors because even within the investment portfolio, we generally want some balance. You talked about this with the more conservative side with bonds and fixed income, with the opportunity side of the stock market and equities. But even that bond and fixed income side over the last several years has had volatility more so than really almost ever before, or at least more significant than in many periods in the past. Can you talk about what that balance traditionally represented versus what investors may need to understand about correlated and non-correlated assets today?
Sure. Yeah. And, let's kind of transition this into, interest rate risk. So interest rate risk is the impact that rising interest rates, in our example here, has on your fixed income portfolio or your bond portfolio. So if you have a portfolio of bonds paying 4% and interest rates raise to 6%, the value of your 4% bonds goes down because who's going to buy them at face value when they can buy 6% bonds at face value? That's what we ran into in 2022. So the 60-40 portfolio was really broken in 2022 because stocks went down and bonds went down. And that's what Peter meant by correlation, right? That was a lot of interest rate risk, fear of recession with all of those interest rate increases that push bond prices down and stock prices down. That typically doesn't happen in a normal cycle. So now things are a little more normalized. It looks like we're going to be cutting interest rates. So bonds are going to perform their more traditional buffer, let's call it, in a stock bond portfolio where stocks fall, bonds are going to hold their value, and and you get the interest off of the bonds. That helps them maintain kind of that. I don't want to call it principal protection, but a safer strategy than 100% in stocks.
Yeah, and I was gonna follow that up, Chris, but you answered it. Do we expect that to reverse back to more normal conditions as the Fed is talking about now? They have finished raising rates and are talking about cutting those rates. So, yes, we do. It sounds like, Chris, think that that will return to more normalcy moving forward, and it may be a good time, therefore, to do that rebalancing, right?
Yeah, absolutely. And and nobody knows what the Fed is going to do because they stopped raising rates. I think was it like in October or something,
Of
September,
last year,
October
right?
of
Yeah.
last year. And we all thought interest rate cuts were going to come in March. But, the Fed's job is full employment and 2% inflation. And we certainly had full employment. So they were really concentrating on bringing that inflation down. So delays and delays and delays on the interest rate cuts, but it looks like it's going to happen here in September. And now they've got to watch cutting interest rates so close to an election cycle so that they don't seem politicized. So I was one that was of the opinion that if they were going to cut, they could have cut in July and August and said, well, look, we're gonna lay off until after the election, so don't read into anything for 60 days, basically.
Mhm.
But that didn't happen yet. But we may get one in September, and then maybe they'll delay until later part in November after the election on the 5th or the 6th, I think it is this year.
Well, you've mentioned the election several times. Of course, we've got a big one coming up, and elections are obviously important. But as they impact the market, Chris, we have seen over time that generally it does not actually have a tremendous amount of impact. Sometimes there's a blip, sometimes there's a reaction, but more often than not, kind of status quo, steady as she goes. However, Chris, there's also a trend that in the 6 months leading up to the election, there's maybe a much different atmosphere and environment than the 6 months after an election. Can you speak to that?
Yeah, and I'm one of those ones this year. I kind of know the way I'm going to vote and whatnot, so I don't pay a heck of a lot of attention to all the rhetoric going on out there in the campaigns back and forth. And but you know, we've had a divided house, if you will. So we've had Republicans controlling one part of the government, Democrats controlling the other part. So investors like that because, and we're talking big institutional investors because typically nothing really gets done. They don't have to worry about, huge capital gains changes, taxation issues if we have a house divided. So if the election goes one way, with Democrats winning everything versus Republicans winning everything, there you might see some more reaction because you've got one party in power controlling everything. And, you still need that 60 vote piece in the Senate to get something significant passed. And, let's hope for the good of the country, Peter. And I'm not getting political here that two sides can come together and address some of the issues like Social Security, Medicare, and God forbid they address this runaway spending that both parties are addicted to.
Yeah, may be a benefit to us all. We know that any one of us personally cannot continue spending money the way the government has, and Chris, that may be a factor that we look at that impacts market volatility into the future as well. We don't know the source of the next event of market volatility. But we do know that there will be market volatility, ladies and gentlemen, and that's why you must have that plan in place ahead of time. Now is the time to be proactive. Get that plan in place. Your game plan for retirement, that is what Chris McIntire welcomes you to help and get assistance in putting together. He will sit down with you, talk over your current situation, your goals, your aspirations for the future, how your money is working to help you achieve those, and map it all out, identifying the risk, issues, and opportunities. So pick up the phone if you would like to take advantage. No cost, no obligation. 800-868-1194. That's 800-868-1194. 800-868-1194, or online at McIntireRetirementServices.com. McIntireRetirementServices.com. Chris, we appreciate the time and perspective as always. You always help us prevail with level heads.
Hey, my pleasure. Enjoy the show, everybody. Be safe out there. Thank you. God bless.
Tune into Chris McIntire's full radio program and visit McIntireRetirementServices.com for many additional valuable resources, including other great episodes of Game Plan for Retirement with Chris McIntyre. Be sure to subscribe.
The content of this radio show is provided for informational purposes only and is not a solicitation or recommendation of any investment strategy. You are encouraged to seek investment, tax, or legal advice from an independent professional advisor. Any investments and/or investment strategies mentioned involve risk, including the possible loss of principal. Advisory services offered through Brookstone Capital Management, a registered investment advisor.
Fiduciary duty extends solely to investment advisory advice and does not extend to other activities such as insurance or broker-dealer services. Advisory clients are charged a quarterly fee for assets under management, while insurance products pay a commission, which may result in a conflict of interest regarding compensation.